Hey there, my name is JP Albano. I am the co-founder and CEO of Significant Lifestyle Communities. Thank you so much for joining in on this webinar. Today we're going to talk about how passive investing works, right? Let's get into it. Before we go any further, this is for informational purposes. I am not a tax professional or a lawyer. Surprise, this is not a solicitation, okay? So let's make sure that you're in the right place. This is for you if you're busy. You want to learn how to create passive income. You want to learn more about apartment investing. And then perhaps in the future, you want to become less reliant on your W-2 sales income. You want to maybe reduce or eliminate your taxes because you earn a lot. And then maybe you're tired of relying on the stock market for your legacy. So before we get into that, let's get into who I am. My name, again, is JP Albano. I grew up in New York City, the son of a first-generation Sicilian immigrant. I always wanted more money than what I had growing up, which was really nothing. I was an IT engineer turned IT sales executive who killed it in sales. I did $200 million of sales in my career. I discovered apartment investing as a way to save money on taxes. So this is me with my family at the beach. My wife is a Jersey Shore girl, and you can see that I'm a girl dad. I love my people family and my car family. This is me picking up my two amazing cars and me pointing to a stage roundtable discussion that I was part of for a real estate discussion. I love traveling to the beach with my family, and I love buying and preserving B&W history with my passion for cars. So next, we'll talk about us real quick as a company, who we are, what we stand for, and more importantly, what qualifies us to be in this space. So Significant is a vertically integrated multifamily investment firm. We specialize in value add multifamily apartments. We've owned 700 apartment units in 3 different states, and we've completed over $60 million worth of transactions. We buy old apartments and fix and flip them. We force appreciation and use cash flow from rent to make attractive, low risk investments for our investors. So let's get started. There are two types of investors, those that are active, right? And then those that are passive. And as mentioned, this presentation is really going to cover really what you're interested in, which is becoming a passive investor. But first, you need to understand the two types. So let's start with the active, right? As you can imagine, an active investor like myself is someone that's actively doing the work, right? They're finding the deals. Maybe they're doing all the legwork. They're responsible for putting all the deal together, doing the due diligence, and obviously operating the business for the deal itself. And on the contrary, a passive investor is like a silent partner, right? They add their value in the form of a financial investment in a project, and the rest is up to the active investor to execute the business plan and obviously to make the money. And there are a ton of great benefits to being a passive investor, right? Some of course, they're double-sided, right? Like lack of control. That could be a good thing, but do you really want to take over repositioning of an apartment complex? No. Let's let the experts do that, or perhaps maybe being involved in the day to day. Forget that stuff, right? You go keep selling, and we'll keep making your money for you, and we'll get into more of the risks in the next slide here, right? So let's talk about both sides of the coin here. There are risks really in everything that we do, right? Waking up and taking a shower, there's risk in doing that. And our job as a sponsor or an active investor is to identify all those risks that are out there in a particular deal and mitigate them to the extent possible. Now, of course, there are a number of great benefits to being an investor. Uh, of course, passive means that you can leverage your time more efficiently. You can keep crushing it in sales, and we take the cash that's sitting in the bank and put it to work, right? Being a passive investor helps you stop trading your time for money like everyone else who's in the rat race. And unlike a REIT or some Vanguard fund where your 401k is maybe sitting, you have more control over the types of investments that where you want to put your money into, right? And I know for me, I didn't like keeping my money in the rigged stock market casino. Now let's keep going deeper here. Really, there are two classes that are in an investment. There's the GP or the manager, also called the sponsor, right? And then the LP. You are the LP. I am the GP. LP means limited partner, and the general partner is the GP. So GP equals general partner, LP equals limited partner. You're the LP, I'm the GP. Let's discuss how these return arrangements work and how you get paid. So in this first example, there's what's called a fixed rate. There's a number of different types of returns, and we're going to break those down. So the first one we're going to cover is fixed rate. So for example, a fixed rate could be like a 7% coupon that you get each year. This could be paid out later, called an accrue or accrued, or it can be current, meaning you're paid on a fixed interval, like quarterly or monthly, right? So one is you're paid later on, maybe at the end of the project, that's accruing. The other one, current, is where you're paid in a consistent schedule, monthly or quarterly. And this is all defined in legal paperwork. The idea here is that these are concepts that you would see in an offering memorandum or as part of a deal placement, so that you understand what these words mean and how they impact you as an investor. And so, what's nice about fixed rate return is that it's pretty simple, right? You can also potentially limit the upside in sharing the sharing upside, I should say. And maybe you're used to kind of hearing this in your sales comp plan, right? So some investors are willing to give up some upside for a lower risk, lower return rate. It really all comes down to your personality investment, right? There's no right or wrong. These are just examples of how some common structures are. So next is a preferred return. And let's just discuss this example. So the best way to describe a preferred return is the following. Preferred return means that LP investors are guaranteed, I'm doing air quotes, obviously, a particular rate of return. So for example, maybe a 7% preferred return. Let's say in year one, only 5% is paid, means that there's 2% left over because 5 plus 2 is 7. Um, and in year 7, let's say there's 10% paid out, right? That's not what the example says, but I'm reading it to you. So because you're owed 7% per year in year 2, if there's 10%, you get your 10%. I'm sorry, you get your 7%. And because we owed you 2% from the first year, that's taken from that 10%. And then the rest, the 1% that's left over, is usually split between the GPs and the LPs. In other words, preferred return is a way where you can ensure, as an investor, as an LP investor, that you will see a fixed number each year. Whether it takes 1 year to get that number or 3 years to get the number, whatever the timeline is, it helps guarantee or ensure that you get that number every single year annually, right? That's really the breakdown. The other the mechanism of it is too, we'll get into here in a second, is that it ensures that you are paid first before the general partners are paid, right? As an investor, you're putting your money in the deal. You want to make sure that you're getting your money first after the mortgage or the bank is paid. You're next. Then lastly comes the GPs, the managers. So the next piece here is a little wrench in the monkey works here, is what's called preferred equity. And this is commonly found from a large investor group or a private equity group. As an LP, you really wouldn't be typically investing in preferred equity in a deal, but it may be part of a deal structure that you're invested in. So you just be aware of that, right? Your biggest takeaway here is that if preferred equity is part of the deal, you get paid after they do. So the capital stack would look like this. The mortgage gets paid first, then the preferred equity group, then you, the LP, and then us, the GP. All right. So let's talk about the hurdles here. They're sort of like your quota. The takeaway is that this creates a financial structure that incentivizes the GP, us, to keep making the project make money, right? And along the way, the GP gets a larger percentage of cash flows from the LPs. We kind of share more and more into that. And LPs still benefit, but the GPs start tapping into that cash flow. And the benefit for you is that it incentivizes us to keep working and aligns these incentives so that we can make money in the deal as well, right? Like ultimately, we don't work for free. We want to make money, but this is how we got to get there. And so you too make money along with us as we ride this up. And we'll get into more details here. So this is really a continuation of that hurdle concept, right? The waterfall is really how the mechanics work. And in the legal documents, they'll predefine or pre-agree what that breakout structure looks like. So here, an example here. I know earlier we used an example of an LP getting 7%. Let's just say we bumped that up to 9%. Yay. So LP is getting 9%. The first 9% they get from 9.1 or 0.01 here up to 12%. The splitting happens, and now the LPs, you are getting 90% of cash flows, and the LPs are getting what's left over, which is 10%. And then after that 12%, the splitting happens again. We kind of waterfall into another cascading effect, and we go to an 80-20% split. So LPs are getting 80%, the GPs are getting 20%. It's not uncommon for there to be multiple waterfalls. There could be 3, 4, or 5 waterfalls. Some groups have one waterfall. They'll do like an 8% preferred return to investors. And then anything after that is a 70-30 split or 80-20 split. There's no, in my opinion, there's no right or wrong way. There's no, well, this one has less splits to the LP, so it must be a better deal. I'll tell you why we do that. Each deal, each project that we look at is very different from each other, right? There are no two deals that are alike. The value add components, the ability to make money, the timeline for making money, all those things vary. And so as managers or sponsors, we look at the deal and we look and figure out, okay, what waterfall allows us to be profitable for the investors and be profitable for us as the sponsors doing the deal. And sometimes in order to get that, because of how long it takes to make the money, make cash flows, you have to change the mechanics of it. And so you kind of get really creative and you create a number of these steps, these waterfall hurdles, so that you can get to a point where everyone's profitable here. So again, there's no right or wrong. There's no this one's better than that one. It's just understanding how the deal mechanics work for each particular deal. Okay. And so, again, this structure as an LP, it helps to ensure that the people running the deal are properly incentivized and rewarded for doing a great job. If they don't do a great job for you, then they don't get paid. You still get paid, but it's not as much as you could have been, right? So let's provide some things to keep an eye out as you're looking at sponsors and deals. Generally speaking, LPs should be making a higher rate of return than what's being paid to the lender, right? So example, lender rates are around 6% as of this recording. This is recorded in July of 23, where we're just kind of reeling from all these super high and fast interest rates changes from the Fed. LPs, you should be making more than 6% that's paid out to a lender, right? Waterfall and hurdle structures, they could be simple too. It's not bad. It's not good. It's just, it is, right? We kind of talked about that in the last slide here. If there is a preferred equity investor in the deal, know that they get paid before you, right? Assuming that you are not the preferred equity investor, and that's typically not going to be the case. Again, not bad or good. It just is, right? Generally, preferred returns are more favorable than a fixed rate, the first example that we showed, since it gives you some kind of guarantee. And make sure your GP at some point is on the receiving side of making money as well. Otherwise, what's the point for them, right? Since they're going to be underpaid, and you do not want to underpay. All right, so this is really this is the end of the presentation here. Made it quick here. So what are next steps? If you found this content useful and you learned something, that's great, right? I'll tell you that I run an exclusive invitation-only investor club for technology salespeople. I help them create passive income while saving on their commissions from taxes. It's 100% free. There's no obligation. When they become a member, you get access to our exclusive off-market investment opportunities, which are first come, first serve. They also get access to our investor training materials and content. Again, there is no cost. It's 100% free, and you are under no obligation to invest in any deal. If the deal looks good and you want to invest, great. If not, that's okay too. So check out the QR code to schedule a one-on-one time with me to discuss if joining this investment club makes sense for you. Not everyone's a fit. That's okay too.